Welcome to the Financial Modeling Teacher. This video is about estimating volatility for equity portfolio return. It's an application of ARCH and GARCH family of models. Our contents are as follows in this presentation. Why estimate volatility in equity portfolio management? A quick review on equity returns, and volatility is a key parameter. Techniques for estimating volatility, the ARCH model, GARCH model, the maximum likelihood estimation technique, a quick example of an Excel spreadsheet. And once again, we have a couple of references in terms of the source material we've went through in order to compile this presentation. I hope you enjoy it. The first objective is risk assessment. We want to compile a risk-adjusted portfolio. The second one is risk optimization, because we are interested in making sure that our portfolio remain maximizing our returns while balancing the risk. The third one is we want to calculate the value at risk, in a sense that we want to make a provision for any possible loss in the portfolio. So now to read, we are saying accurate volatility estimates are essential for assessing the risk of individual assets and the overall portfolio, so that now the misstatement in the volatility can lead to incorrect risk assessment and poor investment decisions. We have seen in the previous portfolio optimization techniques that we have applied, the first thing we will do is to work out the variance and the covariance of our portfolio of individual shares, even when combined, in order that we are able to at least determine the overall risk profile of the portfolio. Now, the second one is portfolio optimization. Modern portfolio theory uses volatility as a key input in optimizing portfolios. Volatility estimates are inaccurate, then it means the resulting portfolio may not achieve the desired risk-return profile. Because now, in order to do anything, we need to always keep track of this volatility. And every calculation factors volatility. In order to maximize this portfolio, we must know that there's always that balancing. Remember, this was captured especially in the efficient frontier that we plotted earlier on. Now, the value at risk. We always have a statistic called a confidence interval, where there's always that 95% confidence. So at which we always work out the Z value, or the standardized value based on the normal distribution. Then from that, we then factor that 95 confidence. That will indicate to us a possible tail of your distribution, being the point at which we are saying once in certain period there will be such a loss of so much, so that we can say, now if this is a portfolio of, let's say, 10 days, there's possible loss that we need to factor in, so that should this portfolio have a loss, we at least know that at least how much to provide for this possible portfolio loss. A quick review on equity returns. We've mentioned that log returns are simply a logarithm of the ratio of the current to the previous price, and we further assume that returns are normally distributed, and as a result they follow a Gaussian distribution. Despite that, according to the stylized facts theory, this normality assumption is subject of some arguments. But in order to simplify the financial models, we'll continue with the assumption of the normality. Now, volatility as a key parameter. We know that volatility is unseen. We might have a set of inputs by way of returns, time, interest rate, and all the other. But volatility, it means it has to be calculated or implied from some price. So volatility as a crucial measure here is that it represents the degree of variation in asset returns. So that now the high volatility would indicate greater risk and uncertainty, while the low volatility suggests stability. So it is very important that we estimate volatility accurately, so that then we are able to achieve or to use it in the financial applications, as per the previous slides where we said in risk management or in portfolio optimization or even in option pricing. For instance, in option pricing, we might be looking at volatility as an input to the model that calculates the price of an option itself. In the optimization, we might be interested in the expected return that is high while we minimizing the risk, or we finding a minimum risk of the portfolio, typical of the efficient frontier. So the risk management volatility might help us to tailor a risk-adjusted portfolio. We've seen there's always balance between the variance and covariance metrics in our view to calculating the volatility and the portfolio return. Now we come to introduce the various techniques for estimating volatility. We have just a few, the historical volatility, where we can calculate a standard deviation or variance over a long period and annualize it depending on the times that we have for trading. Then we can use those as scaling volatility. The moving average or the rolling statistics, and then the implied volatility, where we can take from the option price where all the other information is available. Then we use a model to work out volatility. There are some powerful algorithms like the Newton-Raphson method that could be used to estimate the implied volatility. Then we have the ARCH and the GARCH family of models, which is at the heart of this presentation. These models are used, are more econometric models that are used for estimating volatilities. The use is portfolio optimization, risk management, and equity or option pricing, as already mentioned. We start by introducing the ARCH model. The ARCH is the acronym for the word autoregressive conditional heteroscedasticity. The model was introduced by Professor Robert Angel in 1982. The main objective was to address the issue of constant volatility. As we are aware, that models or techniques discussed earlier, they are all based on constant volatility. However, in practice, the reality is that there is no constant volatility. We've seen, for instance, that the markets do exhibit those periods of high or low volatility clusters. And once again, we've also noticed that due to this, you have those high volatility periods followed by even higher, and vice versa, which is that volatility clustering concept. And in particular, financial markets do experience periods of high volatility because of some market turmoil or other economic regime switches, or even the most recent COVID-19 pandemic. Markets went very much into high volatility. But then we also have those low periods which are more associated with stability. The ARCH model is represented by this mathematical formulation where we have the error term, the past error term, which is ET minus 1 but all squared, which is found as the current return subtract the average of all returns over a period. But we prefer the GARCH model to model it in terms of that past error terms. Once again, the coefficient A0, which is the average volatility over time, or long-term average volatility, plus the coefficient A1, which is added to the past error term itself. So that now if we have this relationship, we can now have this linear combination to be complete. So that in order to have the value for that sigma 2, we want the values of both parameter A0 and A1, which can only be possible through a parameter estimation process. Now again, in this analysis, the ZT there, which we add to that other term, is simply a white noise term. The white noise term, we said also, we can call it a stochastic shock in terms of the drift and diffusion process. We discussed the shortcomings of ARCH, which prompted also the extension of this research to introduce the model called GARCH, the generalized autoregressive conditional heteroscedasticity by Tim Boleslav. Okay, the ARCH model has got a limitation in the sense that it is not flexible, so it only considers the past squared error term to model volatility, which is kind of restrictive in the sense that the past volatility is not factored into this model or equation. So the other thing is that there's only a few parameters, which is just 2. But should the model increase, it means now the number of parameters will also increase. But in this case, could lead to a very potentially complex situation and even overfitting as far as the ARCH is concerned. Now, the issue of stationarity, the conditional variance is said to be stationary when it satisfies these following conditions. It must be non-negative and also less than 1. So that now in this case, the coefficient A1, which was for the error term, must be between 0 and 1 in order to also to ensure that the variance is always a positive, or it's never a non-negative. Now, persistence. A persistence of volatility is measured by how long past shocks continue to influence the current level of volatility. So the impact of shock on the error term itself, it's captured by the parameter alpha1. So now the more the parameter alpha1 is close to 1, the higher the effect, or in other words, the higher the persistence. The GARCH 1-1 model is an extension of an ARCH model, in a sense that it now captures a more complex persistence. This is achieved by adding an additional parameter or coefficient beta. But also, this model, in contrast to the ARCH model, has got an extra term, which is the past volatility measure, all squared. Then we add that error term plus the ARCH volatility, so that now GARCH here in the case is a linear combination of both the past error term and the past volatility. So now the stationarity in this case is achieved by adding the two coefficients, but in such a way that they remain less than 1. So that now the high sum of A plus 1 will indicate even a longer lasting effect on volatility. In other words, high persistence. Now, the long-run average volatility is simply the average volatility over a longer period. And it's represented by this equation here, where we have sigma squared equal to then alpha 0 divided by 1 minus alpha 1 minus beta 1, which are the terms of the persistence. So here we say the denominator reflects the effect of the past shocks on current volatility. The next relationship that we introduce is the parameter estimation. In order for us to be able to calculate the parameters alpha 0, alpha 1, and beta 1, or in some models could be just omega, alpha, and beta, but in our case we chose alpha 0, alpha 1, and a beta. So now the first assumption that is made here is that the returns RT are independently and identically distributed, so that now they will have a joint density function, which is a normal distribution, which has got the log likelihood function that is equivalent to that relationship here. So that formula is what we need to be able to maximize the L in such a way that when that L reaches the value that is maximum, the L being the maximum likelihood itself, then parameters alpha 0, alpha 1, and beta in our case will find a solution. Now, one example on Excel, if you open an Excel file with the assets, it could be some equity or the closed prices of the index, and then we've taken an example where we have next to the first few returns. So in this case, as you can see, we've got ln BA divided by B9 being just the return between these two, and then we've got B9 divided by B10, etc., to give us those log returns. And next to that, under the variance column, the first entry there would be, we will be in C8, referring to the returns themselves, which is this column. We'll now say this first entry squared. Hence we're saying C8 by C8. This just, we start our working with the squared return. And then in the next column, as you can see, we've got alpha 0, alpha 1, and we have now C9 squared, which is our earlier return, plus beta multiplied by D8, which is another square. So what we are saying here, let's see, first of all, if you go to your spreadsheet and just highlight this area here, highlight this area from alpha 1 up until where we have that alpha plus beta. So it will be from B1 up to, I think, B9, B8 and 9. And then from there, say formula, and then select from cell, and then select the left column. It'll give us this functionality whereby our variables here are labeled next to the name of these variables, so that when we code this in our spreadsheet, it'll give us, instead of cell names, it will give us the actual names of the variables. So the next column is the one where we calculate the log likelihood. Remember the D8 is our variance. Then we subtract then C8, which is our return squared, divided by the variance itself. So that now we have a log of D8, or log of the returns, subtract the variance squared divided by D8, which is the variance, the return square divided by D8. Then from there, the next column, we work out the square root of D8. Whereas this one will give us a variance, but modeled according to the GARCH framework. The next one will give us the square root, which is D9. So about a column with likelihood, we have this DA, subtract return squared over D8. And then we sum the whole of the likelihood column to give us that maximum likelihood estimator there, which is E8, the sum of E8 to E1255. Now that is what we want to maximize in order for that to get those values there. So this brings us to a solver example in our Excel. So when we open data and then we say solver, our first thing to maximize is we set an objective function that maximizes, and it maximizes the cell H7, which is our maximum likelihood function. But we maximize this by changing the values D1 to D3, which are the values of those parameters plus the persistence itself, but subject to constraints. D4, which is persistence, must be less than or equal to 1. Then after that, when we run solve, it'll come back to give us the correct parameters, or perhaps the optimal parameters, which when we run, even the plot on the GARCH will be different. The next thing we demonstrate the plot. The very plot at the top is the daily log returns, which simply exhibits that volatility clustering. We can see that during those periods we have a high followed by higher, and then from there during low periods of stability they become even lower, and vice versa. So the one in the middle, it's the ARCH plot. Look at the ARCH plot. It is very flat at the bottom, but it has got those spikes during high volatility period. So the flat appearance and the spike, it's just a depiction or confirmation that the ARCH didn't have any volatility. It's only the returns. Let's just say in the absence of that coefficient alpha 0, just by simply saying plot RT squared, which is just plot return squared, it will give you something similar to this. But just to enforce that in the absence of the volatility in this equation, we'll tend to get this type of a plot. But now in contrast, the one in green right at the bottom is the GARCH model, which depends on both the past squared observation as well as the past variance. So the plots look more dynamic to represent both the volatility, and that captures the long-lasting volatility clustering. We can tell that even here we still can see or note the volatility clustering. Right, I continue with the GARCH. You can see here's our nice looking conditional volatility for the S&P 500 as produced by the GARCH model. We can see that there's that period between 2008 maybe towards 2010, which is a period of quite a high volatility, and followed by maybe between 2012 up to 2016. There is some stability there with a low volatility sustained over that period. But overall, we can see there's persistence. And once again, between 2020 to 2020, there's that high spike during the COVID-19 with volatility, which then drops slightly thereafter to some stability between 2020 2022 and up to until present. So this is the GARCH plot, which depicts a better shape of the volatility as well as higher persistence as compared to the ARCH model. Now this concludes this presentation, and I hope you enjoyed it. For any further detailed Excel worksheet or a Python code, please email us at thefinancialmodelingteacher@gmail.com. Thank you for listening. I am the Financial Modeling Teacher. Thank you.